Welcome back to this Investing Demystified video series. We've now discussed that 1, we can't outperform the markets or pick an investment fund that can do so for us. And 2, the best equity exposure is a cheap index tracker of world equities. In this video, we'll be discussing the portfolio components that make sense once you accept and embrace that you can't beat the financial markets, which very few people can. But if we can't beat the markets, why invest at all, you might say? Simply put, the reason we invest is because we expect that it will give us more money in the future for the level of risk we're willing to take. In creating our simple portfolio, we split our assets into the lowest risk assets that preserve capital and risky assets that generate return. And we combine the two according to our risk preference. In the low risk bucket, we should have the highest rated and liquid government bonds, ideally available in the base currency of our investments, of similar maturity to your time horizon. You can essentially think of it as an alternative to cash in the bank. I won't go too into the super low risk portion of the portfolio in this video series, but if you want to learn more, there's a whole chapter dedicated to it in my book, Investing Demystified. This is particularly relevant if your base currency is not dollars, pounds, or euros. But if we want to achieve anything other than the very unexciting return profile of low-risk government bonds or cash, we turn to riskier assets. We acquire these riskier assets not for the sake of adding risk, but because we hope to get better investment returns from them. Now, as discussed in the earlier video, the only equity holding you need is a cheaply bought index tracker of world equities. And here's the crazy bit. Now we have two investments. The low risk one, cash in the bank, or better yet, government bonds, and the higher risk one, the cheaply bought world equity tracker. And if we stop here and pick these two in the proportions that suit our risk profile, we're sort of done. That's it. Two investments. And in my view, you have a better investment portfolio than 99% of investors. And nobody is paying me to say this. You can obviously make finance more complex, and many people do so in order to charge you for navigating it, but you really don't have to. If this seems too simple, remember that the world equity exposure represents an underlying exposure to a large number of often well-known companies in many sectors and geographies and currencies all over the world. Your two securities thus get you an amazing diversification along with a minimal risk security that gives you the greatest amount of security possible. How much you want of each depends on the risk return profile you want. So if you can handle the risk of equities, you can perhaps expect 4 to 5% return above inflation per year versus 0 if you put all your money in the lowest risk assets. If you want 50-50, you get half the risk but also half the return. Now you need to think hard about your investment risk profile. The returns of equity markets might seem juicy, particularly in the long run, but also consider that in 2008, equities lost about half their value. In the depression in the 30s, the drawdown was over 80%. And 20 years after the declines started, Japanese investors were still down over 75%. Declines can be brutal, and they happen when you least expect and can afford them. If you have $105 and you need $100 for heart surgery in a year, your risk profile is very different from someone with $100 at the age of 30 who needs $150 40 years later. So the elements of the portfolio don't change, but the proportion of equities versus low risk assets do. There's far more on risk in my book or on the various sites of the service providers, and I urge you to have a look. There's also more in my book about all the things that are not including in this simple portfolio and why, and some additional investments you could consider but don't really have to keep things simple. The world of finance seems impossibly complex, and it really should be simple and transparent. Lower fees are a major benefit of simplifying the often horribly complex investment portfolio, but importantly, this has been done while creating a stronger portfolio. We're not doing cheap for cheapness' sake, but we're doing it because it's a happy byproduct of the simple portfolio construction that gives us the best risk-return profile. I bang on about low fees, but if the only result from watching these videos is that you pay a little bit less for a financial product, the next time you invest, the time spent will have repaid itself many times over. If this portfolio seems crazily simple, it's because it is. There's two investments, one being the minimal risk asset and the other being the world equity investment. We have created a very simple, yet incredibly powerful portfolio for you. Pick in proportions that suit your risk tolerance and you're done. See you in the next video.